All right, we've got quite a market rally on our hands, both on the equity and the bond side right now. The catalyst, inflation in the U.S. slowing slightly more than expected in October. This is increasing hopes that the Fed has done its job with respect to rate hikes. Market even pricing in rate cuts at some point in the middle of next year. For some perspective on what you should do in your portfolio, let's bring in Lorne Steinberg, president of Lorne Steinberg Wealth, and Dan Rohinton, portfolio manager at IA Global Asset Management. Lorne, you're in the studio, so I'll start with you. Is this a green light for the bulls?
Well, I think it is, and I think what we're seeing today is the beginning of what we expect to see in 2024, quite frankly, which is inflation abating. Look at the bond market reaction, massive drop in yields, and stock market reacting accordingly. That is bullish for all kinds of equities, but especially for those that have been beaten down, like all those big dividend payers, been gotten clobbered in Canada and elsewhere.
Dan, it took about 3 months for the S&P 500 to correct. It's taking 2 weeks to uncorrect, to go back to those levels pretty close to that we saw in July. Short, sharp rallies to the upside. What do you do with those?
They're different based on the regime, right? So we're entering a regime where inflation's under more control and the last of the Fed hikes have been priced out of the market. So now it's all going to be a question of economic data and profit margins for the sectors and the companies itself. So as you look forward the next 6, 12, 18 months, we got to make sure that the economy momentum that we've had so far holds in the face of basically flat Fed behavior. Because if we start seeing cuts, you have to remember that it's not going to be because the news is so good, it's because the news is difficult and poor. So we're in this Goldilocks environment. We're in a positive backdrop going into year end, but I think it's going to get more difficult as you go to next year and the year after.
And yet, when you look at the factors of what exactly has rallied, tech, obviously, has carried the day on both sides of the border, Lorne. But, you know, on the TSX, the bank stocks are the second best performing index since the October lows, behind tech. Utilities are up nearly 9%. Some of these really beaten up sectors are finally getting out of bed. Are you picking away at that?
We are. So listen, the big dividend payers, banks, telcos, utilities, et cetera, were clobbered in a world of rising interest rates. And so, you know, looking forward, we're very bullish because those stocks, especially things like Canadian bank stocks, Canadian telcos, to a lesser extent, will be growing their earnings over time for the next number of years. At the dividend yields you are picking up as an investor with a 5-year time horizon, a 10% annualized return when over half of that is from dividends is, we think, very achievable, and this is a great opportunity, despite the volatility, and Dan pointed out.
Well, Dan, I've asked you all the time, are you getting into the banks? And you've been cautious. Are you willing to step in now, or are you still reserving the right to kind of wait for a better entry point?
We're waiting for a better entry point. We think that there is more volatility to come, and as long as the rate regime is where it is today, it's going to be tougher and tougher for the Canadian consumer. So we're taking advantage of opportunities like this to actually own more waste management companies, more defensive companies, and also utilities and telcos as well. I would agree on that point. So we're not going into the cyclical yielders like the banks are just yet, because we want to make sure that the housing backdrop is sound, robust, and on that footing, because then things can get a lot clearer for their fundamentals.
So, Lorne, what's your counterpoint to that?
My counterpoint to that is I think investors really need to sit back and say, okay, I'm not investing for the next 18 months. I need to have a 5-year time horizon, at least, that's for sure. So when we're getting a 5% dividend yield, you know, average on the Canadian bank stocks, do we think the Canadian bank earnings 5 years from now will be at least 25 to 30% higher than they are today? That would be much slower growth than they've had in the past. That will basically give you probably a double-digit annualized return, especially if bond yields drop a lot. And so for us, I mean, if we don't step in when there's, you know, lack of visibility, we're probably possibly going to buy them, you know, 20% higher. And so, you know, if not now, when? And the same thing for the telcos, Amber. Listen, Canada, we have immigration here. Canada's a growth economy and a growth country. And again, with, you know, 6 and 7% dividend yields on the telcos, it's hard to go wrong, even if those stocks never go up.
What do you do, though, with that tech basket? Do you want to keep it in the portfolio even as you're nipping away at some of the laggards, Dan?
You want to have a consistent positioning in technology. because it's one of the most dynamic and innovative parts of the economy. But tactically, we're getting more and more cautious there because valuations have come in. So the last time we had talked about Meta, Google, some of those areas, I think there's still lots of opportunity there. So you can tactically pick away at certain stocks, but as a sector and as a broad factor, we're bringing that down slowly just to redeploy back into areas like utility where more yield exists today. So you always need to be there. It's just a question of how much you want to overweight and underweight. And we're moving towards more of an underweight than we were before.
What about you, Lorne?
Well, I think we're somewhat in sync here with Dan. First of all, we are not selling our large cap technology stocks because, first of all, the growth, the balance sheets, and also the investments that we don't even know what we're in, but Google's spending $40 billion a year, Alphabet, on R&D, which is being played out now through AI and other things. Those are unique businesses and big growers, still double-digit growers. So we remain present there. But it's for us an opportunity to be balanced out elsewhere because investors have just completely ignored other sectors of the market.
Well, let's just go back to financials as we're talking about the banks. One sector within financials that has loved the higher rates has been the insurance sector.
Absolutely.
Is now a time to re-rate? Do you overweight banks relative to life cos? Do the life cos start to underperform as rates come down?
Well, we certainly have a fair weighting in stocks like Manulife and Sun Life and Fairfax in Canada. And we don't think we're there yet, and nor are we predicting that interest rates are suddenly going to get cut imminently. But looking into 2024, we will probably, the bias is the rates will go down versus go up. 10-year bond yields down somewhat. The insurance companies are still, a great place to be and offer good earnings growth. But some of the stuff that has done really, really well, large cap technology being one of them, is it a place to rebalance a little bit for us? Yes, because there are really good opportunities elsewhere, probably with less risk.
How do you think about that insurance versus banks piece, Dan?
I think that's a bit of a false choice, Amber, because life insurance and banking don't need to go together. You can also incorporate P&C just in that specific part of the market. You can expand into payments and fintech as well. So we don't need to decide between which end of the curve we need to be on with life cos and banks. I would say we need to be more balance sheet light than balance sheet heavy. So we can underweight the whole space, and I would prefer P&C as a starting point, but I think payments is a far better place to go. To do that, we need to be global, but at the same time, there is opportunity to do that. So I don't think those two areas are the parts of the market you really want to focus on. Even in financials, you want to focus on balance sheet light, but at least start with property and casualty insurance, like the Fairfaxes and the Intechs of the world, specifically in Canada.
Before I let you gentlemen go, one of our top stories, of course, is Teck Resources. And we talk about sort of cyclical and then structural themes, and everybody is really obsessed with this structural theme about critical minerals and them needed for the green energy transition. Do you want to buy this new Teck Resources that is going to be free and clear of the coal business, Lorne?
We're not a buyer of tech here, let me say, and I have to say I'm always a little wary when the next mineral is going to be the big mineral like lithium and everything else, because we've seen that game played out before. I don't think it's probably a bad move for Teck to make this move, if only to improve their balance sheet. We don't think commodity stocks like that should be heavily levered, so probably not a bad move. Of course, it all depends how they redeploy what the cash they get, but we are not a buyer here.
Dan?
Yeah, I would agree. We're not a buyer of tech, and generally speaking, we avoid the broader coal and material space in general because the returns on capital aren't that good. But I will make one comment and say that Glencore is pretty astute in their thinking approach, and they have been for decades. So if anything, this makes us more interested in looking deeper into Glencore and why they double down on met coal at an opportunistic time.